Thank you, everyone, for joining us today, and welcome to the first of our co-op conversations events for 2023. Happy New Year's as well. My name is Marc-Andre Pigeon, and I am the director for the Canadian Center for the Study of Co-operatives. And before we begin today's conversation, I think it's important, as always, to acknowledge that we're coming to you from Treaty 6 territory. And this is the traditional land here in Saskatchewan of the Cree, the Saulteaux, Dene, Dakota, Lakota, Nakota, and the Métis. And I acknowledge that as we meet and share and learn from each other and have these conversations about a really important topic, that we're all treaty people, and we all need to kind of affirm our commitment to the hard, shared necessary work of reconciliation. And I think Ritu's talk, with respect to climate change is a really important part of that ongoing conversation. So with that, I'm actually going to introduce you over to Ritu Linfoot, our featured speaker today. Now, over her very impressive 30-year career at Vancity, Canada's biggest credit union, I might add, Ritu has had multiple leadership roles at the branch level, in IT, on projects focused on large-scale change management and business activities. And she's currently Director of Risk Operations and Enterprise Risk Management, Enterprise Risk at Vancity. Now, this work is crucially focused on providing risk advice around new and emerging strategic initiatives, as well as oversight of risk management controls, including climate risk management, important part of today's conversation. Now, I got to know Ritu because she was a student at St. Mary's University's management or Masters of Management program in cooperatives and credit unions. And I had the great honor and pleasure of working with Ritu on her master's project, her final master's project. And it was because of that engagement, I thought Ritu's work is important and I think needs to be shared more widely to provoke a conversation in credit unions and hopefully larger cooperative sector as well. And so that's what we're going to talk about today. Ritu's going to share with us some of her research findings from her master's degree work. And we're going to have our usual conversation breakouts, and then we'll wrap up. Now, just for those of you who are new to this process, and before we hear from Ritu, a word on our series. So the way we do things is we have about 15, 20 minutes of Ritu sharing some of her work. And then Ritu and I will have a short conversation. And then we're going to break out into little groups where we're going to pursue those conversations a little further, a little more intimately, and then we'll regroup. The idea here is to kind of build networks and, kind of help people kind of learn about each other over the cooperative and credit union sector. I should add that if anyone's experiencing any technical difficulties, you can message Stan Yu. Stan, can you wave to folks there using the chat function? Thanks, Stan. Some of you know Stan, he's a regular here. And we're going to be recording this session. I flagged that at the beginning. And we're going to share the link back with all of you who joined today's call, and the recording will be available on our YouTube channel. So with that, gives me great pleasure to hand things over to Ritu, and Ritu, over to you to share some of your work.
Great. Thank you so much, Marc-Andre. Hi, everyone. It's an absolute pleasure to be here today. So before I kick off my conversation, so while I meet with you on a virtual platform, I'd like to take a moment to acknowledge the importance of the land in which I call home, and I acknowledge that I'm on the territories represented today by the Musqueam, Squamish, and Tsleil-Waututh First Nations. They have been the custodians of this land for thousands of years, and I'd like to pay my respect for the elders, both past and present. As Marc-Andre mentioned, I'm the Director of Operations for the Enterprise Risk Management, let me start that over again. I have a long title, but I am the Director of Operations and Enterprise Risk Management for Vancity Credit Union, which is Vancity Credit Union and also a federally chartered bank, amongst other companies, but referred to as Vancity. And my pronouns are she and her. And I've worked for Vancity for 30 years, as Marc-Andre mentioned, various different roles throughout my career. So my current role at Vancity includes the development and implementation of our enterprise risk management framework. And this is to support our execution of our vision. My team supports the structured, they support structured reporting and analysis of risks that we develop standardized reports that we track how these risks are doing. And we elevate this to our senior leaders and to our board to enable better risk mitigation decisions in the pursuit of our goals. As mentioned, I'm also a recent graduate of the Master's in Management, Cooperatives and Credit Unions program at St. Mary's in Halifax, and I chose this very topic as my final research paper. I sought to understand what, if anything, credit unions were doing to assess climate risk. So in my daily work, I actually find that I draw on that research experience often. The topic of climate change is and remains of critical importance. So we may be able to enjoy a sustainable future for our individuals, for our families, and the businesses and the communities in which we serve. So I'm thankful for this opportunity to share with you Vancity's response to climate and how we are managing our risks in the pursuit of our goals and objectives, and also learn from you. Stan, are you able to advance the next slide? I believe you should be able to see a slide called net zero. I may not be able to see it in my view here, but oh, perfect, thank you. Okay, so what is net zero? Actually, there we go. I had to just get my speaking notes, my apologies there. So I'll start with this terminology, net zero, because we hear that, and I just want to take a moment to talk about, like, what does this really mean? So simply put, being net zero means cutting greenhouse gas emissions as close to zero as possible to begin with, so that any remaining emissions can be reabsorbed through our oceans and forests in the atmosphere. So that means a company or country making a pledge to become net zero will make significant changes to achieve this objective. And this is different from carbon neutrality, which is actually the practice of buying, balancing your carbon emissions that you have as a company or a country with an equivalent amount of offset purchases, where you invest in certain initiatives that actually support, climate change. So this means a company or country could become carbon neutral by purchasing these offsets, but not actively be taking the steps to reduce their emissions. So why is this so important? Because climate shows that in order to avert the worst of what climate change could bring to us and preserve a livable planet, we need to limit global temperature increase to no more, to 1.5 degrees above pre-industrial levels. So pre-industrial was the 1800s. And currently the Earth is sitting at about 1.1 degrees Celsius increase from that time period. So we're very close, and we want to limit the increase to no more than 1.5, or between 1.5 and 2, preferably 1.5. So in order to keep it at 1.5, this calls for commitments that countries have made across the globe in the Paris Agreement to take significant steps to reduce their emissions and to achieve net zero by 2050. So in other words, we all have a lot of work to do. Next slide, please. So we know change is coming if this is the case. And we know, in order to achieve net zero, we see this transition has got to be one of the greatest challenges that humankind is going to face. We need organized effort across the globe. It calls for nothing less than a complete transformation of how we produce, consume, and move about. And these changes need to be an immediate priority, and a sustainable effort for years and decades to come. So we see the energy sector is a source of about 3/4 of greenhouse gas emissions today, and holds a key in averting the worst of what climate change could pose on us. And replacing things like coal and gas and oil-fired power with energy from renewable sources, such as wind or solar, will dramatically reduce our carbon emissions. And we know that many governments, the federal, provincial, municipal, all over the world, are looking at ways to reduce. And we see the financial industry needs to partner with these organizations, with these governments, in order to make systemic changes. So in Canada, the government is committed to achieving net zero by 2050. So that means there's a lot of innovation that needs to happen in order to meet this long-term goal and significant changes to policy. In BC government, we want to reduce emissions by 40% by 2030. So this equates to significant reductions in emissions from things like buildings and communities and transportation for this province. And you see on the slide here the amount of reduction that that Canada and BC in particular would like to see. And I don't have the data for your province, Marc-Andre, but I thought I'd put BC's information on there. And we go to the next slide, public expectations. We know that this is very important. It's very important to Vancity. It requires us to look ahead years from now and consider what is the impact that we are having on the community around us. And it requires us to also understand where people are at. And in order to understand that, we did some public opinion research to gain an understanding. And it told us that 90% of Canadians across the country expect their financial institution to act on social and economic issues, because they expect of where they put their money in their bank or credit union of choice, that financial institution will take appropriate action on social and economic issues. And this prompted us to think about at Vancity, where can we lead? Where can we be different and not follow? And if we know what that is, what are we going to do about it? So we know that the financial sector, we're not alone. Us and other organizations are announcing their net zero commitments or taking the steps in order to understand what that should be. So Vancity announced ours last January. And at the time, we were the second financial institution in Canada to do so. I don't know off the top of my head who was the first, but we were the second and the first credit union. And since that time, many of the big banks, the big 5 banks, have also made their commitments, and this is gaining steam. So I will flip to the next slide here. A little bit about Vancity. There's a lot of information on this screen, but we use the terminology Vancity is a financial force for change. And what we're saying when we say that is that our pathway to addressing the climate emergency is with and through our members, because we're a cooperative, and that needs to drive our approach. Yes, we need to transition to a low carbon economy, but we need to do that in a way that's equitable and inclusive. And we believe this is where we'll be different in our approach than other financial institutions. And we are looking at how we're going to use our tools of finance to address these inequities that exist both now. And unless we approach it differently, those inequities will only drift further and further apart. And we want to play a key role in addressing this in an equitable and inclusive way. So about our vision and values, we know that the climate crisis is both a human and environmental emergency. And we recognize financial institutions have a critical role to play because we have the tools to support our members through the climate transition. We don't produce a product, we don't manufacture anything, but we do finance everything, as financial institutions do. So we use these assets, meaning our lending and investment portfolios, to help improve the financial well-being of members, while at the same time helping to develop healthy communities that are social, economically, and environmentally sustainable. That means both serving the financial needs of our members and then also looking to address those systemic challenges such as inequality that climate change will oppose on us. So we did some self-examination. So how do we ensure that when we make a commitment, that we are actually going to turn that into action? Well, we started off by looking at our portfolios. And since 2008, we were, actually in 2008, we became the first North American-based financial institution to be carbon neutral. And I mentioned that earlier on in the slide deck. And we have systematically been making changes to our buildings and our structures to be environmentally friendly through various different means. But when we look at our assets, and in this case, our biggest asset is our lending portfolio. What that means, our members who have mortgages on their homes and businesses and buildings makes up our lending portfolio. And we look at do we understand enough about that to understand what the emissions are that's being generated across both our operations and our portfolios. And we saw that the bulk of our business activity emissions actually comes from our mortgage portfolios. You can see on the screen there, it's 79%. And that's significant. So if we look at those loans that we finance and understand what happens when members heat and cool their homes and businesses, and we evaluate that, we see a great opportunity to make an impact here by focusing on our lending portfolio. So we made a number of commitments. Stan, we should be on the climate commitment slide. So I mentioned earlier, Canada has a commitment to be net zero by 2050. Well, we want to be net zero by 2040 across all of our mortgages and loans. That means the carbon that is being emitted from anything we finance, we will take steps to eliminate those or significantly reduce those, and with any remaining emissions being brought to net zero. So that means we've set some targets, and I'll get into those details in just a bit. And I have a link here for the rethinkvancity.com website if you wanted to explore a little bit more. It's full of information around our commitments that you see on the screen here, and exactly how we're measuring and setting our interim targets for ourselves. We also believe that you can't just have that commitment by itself. And what you see here is that we believe that we need to invest in a better future by offering only socially responsible investment options that can demonstrate the integrity of our work. And so the screening process and the stewardship process of who we partner with for investment options for our members need to meet a certain criteria in order for us to offer that service to our members. We know that we need to have equitable transition opportunities and provide products and services that enable our members to finance their own climate transition. If they want to make improvements to their home or business, using the tools of finance, how do we support our members to do that? And that comes through the services and products that we offer. And we also need to be very transparent and accountable. So if we say we're going to do these things, and if we say we're going to make this change, we need to show it and prove it. And we have been taking active steps for quite some time to disclose where we invest and how we invest. And we have robust reporting in our annual reports, and more so coming as it's specific to climate as well. So we want to make sure that we're accurately measuring and openly reporting how our actions are impacting the well-being of our members and our communities. The more transparent we are, the better our response will be, and the more it will show a path for others who are doing the same thing. And lastly, we need to walk the talk. So if we're saying that these are our commitments, it needs to show up in our daily decision-making across the organization. So the path to net zero by 2040, while we know many financial institutions have made similar net zero commitments, we see two things that are significantly different for us. First one being 10 years ahead of the recommendation. The UN IPCC stands for Intergovernmental Panel on Climate Change. We believe the pace of change needs to be more immediate, and 2050 is a very long ways away from now. So we want to be taking those active steps much sooner. And we see that setting interim targets for 2025, just 2 short years away from now, is a good checkpoint as well. And we anticipate that we may move that every 5 years, set our interim targets, report against how we're performing, and then continuously set. And the reason for that is because we may need to double down, triple down, or even more so in our actions if we're lagging behind. So in order to get towards a net zero, we recognize that we can't do this alone. We really do need the support and work with others. So we do know that we'll continue to evolve how we measure and report our current loan and mortgage emissions. And so we continue to look to products and services and tactics and strategies that we need to continuously evolve to build our targets to 2040. It's the actions that we do today. We're going to need to keep checking and calibrating as we go to make sure that we're actually moving forward, and the continuous development of products and services to meet our targets. So we know that we have to work with key areas on public policy changes. There's a lot of consultation that happens with financial institutions from the federal, provincial, municipal governments and regulators. And the opportunity to be early at the table, to be invited to the table, to have conversations around what can and should change to support climate change is always beneficial. And it also helps us understand what's coming and changing. So my work also involves working with others in Vancity on some of those consultations. And it's very interesting to see early what is being contemplated. And we need to continue engaging with our members. They are at the heart of all of this change, and we need them to walk with us. So we need to support them with their emission reductions. We need to upskill our staff, for example, to have meaningful conversations around climate change with our members. And look to have public education webinars and partner with different community members in order to promote the discussion. And we know that our business is growth in lending and investments. And so we need to ensure that we're continuing to grow, but doing so in a clean way, in a clean, lower carbon emitting method. So I've shared with you a lot about our approach and how we got to the point of setting our objectives and how we see the path forward. So I'm going to switch gears a little bit into my realm around the climate risk management aspect of it. So because Vancity has elevated this issue as a strategic priority, and we talk about it at our senior levels and with our board members on a regular basis, it is elevated as an organizational priority. And so with that, my role, my team's role is to support, provide early warning signals, if you will, and support reporting on, are we on track or off track of some of these things that we want to say? And we report against many dimensions like market, liquidity, and others. Climate is definitely one of them. So we have something called a risk appetite framework, normal terminology for banking, and other organizations use it as well too. And what that is a strategic document that outlines key areas of possible risk for us in the pursuit of any of our objectives. These dimensions allow us to group risks around these categories and understand their impact to us. That involves for us, we have 9 different dimensions. We have strategy, market, things like liquidity, very, very important in a financial institution, the health of our credit portfolio, the well-being of our people, the efficiency of our processes and technology, and any considerations around legal and regulatory. And we've elevated climate to have its own. Yes, it shows up across all those areas that I mentioned, but it has a place of its own in our risk appetite framework. So we want to understand our exposure to climate change and understand early and often if there's anything that may keep us from meeting our climate objectives and goals. So with these different dimensions that I mentioned, my team generates a report on a quarterly basis, and that serves as a reporting mechanism for our senior leaders and our board, so they may understand if we're on or off track. So we know that this is a complex topic, and it understands involving the risks we might be facing right now, but also how our actions are going to contribute to problems and solutions in the future. So that's tricky. It's tricky to understand, to think about like, what's the risk right now, but what's the risk 20 years from now? What's the world going to look like? Are all the countries going to do what they said that they're going to do? And that makes it challenging, but also very, very interesting. And so with that, we also work closely with others in the organization to disclose to our members and stakeholders how exactly we're doing. So the climate risks uses like interesting terminology, but I'll go through this in a moment here. So we know that we're feeling the effects of climate change all around us. We see it, we personally experience it season over season, and we see it happening across the world. We know weather patterns are no longer linear, they're no longer predictive, and we can't rely on past data to predict what's going to happen in the future. We know that there's rising regulatory and commercial pressure to protect ourselves from the impacts of climate change and to align to global sustainability agendas. So we know that climate risk has the potential to create really adverse consequences for Vancity and all financial institutions in meeting its climate goals and objectives. So we have to consider things like the impacts of it on our lives, our health and well-being, the economy, the social and cultural assets that we have, and our, in our entire ecosystem. So there's types of climate risk that we talk a lot about in financial services. You may or may not have heard this terminology, but we talk about physical risks and transition risks. So in summary, these are two broad categories. Physical risks are the risks resulting from climate events, things like wildfires, storms, floods. Like, how does that impact people's homes? Like, that is a physical asset for financial institutions. Yes, it might be your home, but it's a physical asset for us. And when there's acute or extreme weather events that could impact large geographical areas, it does impact the financial institution as well too, especially if we think about credit unions that serve very rural areas. How does that impact the health of the credit union system if an area is deeply impacted by an extreme weather event? And so we need to contemplate, what does that mean? There's things that happen in an acute nature and things that will happen gradually, like rising sea levels, that kind of thing. This is super important in particular in BC. And so the other type of risk is transition risk. So that comes from big sweeping changes in public policy. We're going to stop, using this type of fuel, and we think about that at the industry level. So if our members work for that particular industry and there's significant change to that industry, how are they able to meet their daily needs? Like, how do they pay for their mortgage? How do they invest? How do they send their children to university? Things like this. Like, these transition risks are, things that would happen at the industry level, but it's good to understand at the asset level and, broad sweeping at the industry level. In transition changes would involve things like, policy changes and new technology, new regulations, and there's a lot of movement in this place. So it's very interesting to watch what's going to happen at the government levels and understand how this is going to impact our cooperatives. So we know that it's very important to understand climate risks. Banks in particular, we have to maintain a healthy financial system in order to keep the economy going. And we are coming under rising regulatory pressure to protect ourselves from the impact of climate change and to align to, a lot of industry levels. So what are we doing at Vancity? So we're measuring current flood and fire risk in our lending portfolio. We're working on understanding and growing our understanding of transition risks at the industry level by measuring our exposure to certain industry sectors. So we're looking at our residential portfolio, we're looking at our commercial lending portfolio and investments, and we continue to advance our disclosure work. So that analysis takes a fair bit of effort. We kind of divided it into two parts, and this has been a bulk of my work over the last few years, working with others. But the first phase of work, and this is ongoing, we take a very quantitative analysis, meaning we pull data from our existing portfolios. It's a static look at, where are our assets? Where do our members live? Do they live in fire zones and flood zones? Do they, how do we understand this better? And while that's tricky to know, we needed some guidance from, the government of Canada and some of our regulators. Where do they see risks in the broad geographical area of Canada, and how does that impact British Columbia, and how do we understand that for Vancity portfolio? So we did a lot of that type of analysis, and we were able then to categorize, differences between our asset physical risks and transition risks. And we've been reporting that to our board all throughout the year on a quarterly basis, and having robust discussions around what is our risk exposure, and happy to report that it's low. But that's now, right? Over time could be a different story as the world changes around us. But it helps us form a baseline understanding, because if we waited till data was perfect, we would be waiting till 2050. And so you work with the data that you have. So we partnered with Co-operators Insurance Company. They're an important partner with Vancity, and they have some risk tools, and we were able to work with them to understand, flood and fire risk. And so we, as mentioned, we report that up to our board, and that's, I call that the RAF, that's Risk Appetite Framework, just a little bit of an abbreviation in there, but it's a key report that's used to report these risks. And so while that's helpful to understand, what's our current position, we know when it comes to climate change, we have to take that long view. So how do we do that? We're not, climate scientists. We don't have fancy tools, but they're out there in the market. And so we did partner with European risk. They have a risk modeling tool, and they have very robust, future-looking scenarios based on science, based on approved different plausible scenarios. And we're able to run our data in there and saying, if we take our current portfolio, what does it look like in 2030, 2040, 2050? And, does that inform anything for us? Does it trigger some changes that we might want to contemplate? And the answer could be yes. Like, we don't see any immediate change right now, but it helps us to understand what are some natural hazards that we have to watch for. And in the future, it could lead to some changes that we want to limit how much we invest or lend in a certain area, or more so in a different area. So as much as it helps you understand risks, it should also help you understand opportunities as well. So we're exploring how to better use this tool. So I know I have said an awful lot there, and I'm wondering if this is a good time to have some questions.
Yeah, Ritu. So I'm gonna have a chat with you for 1 minute, then we're gonna do a breakout, right? So and we'll come back, and maybe if there's a little bit of time, we can open it up for a plenary conversation. So the question that's burning in my mind, Ritu, is your research. Okay, so you've made a compelling case for why Vancity is doing what it's doing, right? It's the right thing to do, but it's also good for the business, right? You're anticipating regulatory changes. You're planning for potential likely floods, fires, other environmental problems that will affect the business. So that all makes sense. Okay, but your research was about looking at how the cooperatives and credit unions in particular are using their cooperative structure to kind of plan for this. And you surveyed some credit unions. And what did you find? Can you share with people what you found and link it back to, I'm curious. So Vancity's clearly a leader in this space. Do you see that same thing happening in credit unions elsewhere? And if not, why not, do you think?
Right. Super great question. In short, well, actually, I will start by elaborating. Yes, I did survey multiple credit unions across Canada of various different sizes. So the questions asked were, have you elevated the climate conversation to a strategic level? And there was a different response. Many credit unions said, yes, we have. And when I asked for, exactly which way or how have you done that, I felt like it felt short, to be honest. And the reason why I say that is because I didn't see consistency, Marc-Andre, across the different surveyed credit unions to show, like, I'm not suggesting that Vancity's nailed it and they got it right. But what I'm saying is that I didn't see consistency in two aspects of it. One, that it's been elevated as a strategic priority, meaning your board is talking about it, or you're talking about it with your members and taking it to your board. And there's ongoing conversations about it. And that you're actually monitoring or taking the steps to understand your current risk exposure. That part was extra fascinating to me because we're all heavily regulated in this industry, and we know it's coming. So I felt it very interesting that when we talk about our cooperative history and who we are, and we're carbon neutral and the first to do this, and we're going paperless, like those are all wonderful things, and we care so much about the environment. We've been talking about it for decades, and yet we're waiting. We are waiting for someone to make us do something, and then we're going to do it. Right. And I'm like, wow, okay, that's fascinating. Why are we doing that? And what's keeping us from moving it forward? Is it that people see this as a political issue? Do they see it as like, oh, it's too complex? We're going to wait until the provincial regulator or the federal regulator to tell us what to do, and we shall do that. Which is such a missed opportunity, because, if I go out and ask my members today, and I can say, oh, Vancity is doing all these things, we're going to get a huge variety of what people understand around climate. But as a financial institution who invests in communities, and communities are under threat from climate change, I don't think there's an opportunity to wait. I don't know why we're waiting. Right. Nobody should be waiting, whether you're a financial institution or any other type of cooperative. Like, we're already probably contemplating it, but it just needs more energy to pull it together and take the first step. Because as I mentioned before, waiting till you have the perfect data to tell you the perfect story and gain insights from that and then taking action is really not an option, because before you know it, in the credit union world, those regulators are going to be knocking on doors expecting you to have answers. Right. So in summary, I found the actions didn't match what they perceived to be a strategic activity enough. Right. And what I'm finding since my research and, further conversations and folks that want to connect with different folks from Vancity, including myself, is that they're just starting that journey, which pleases me deeply. That's fantastic. Great. I'd love to share. Let's keep talking about it always, because we have lots to learn too, and we can learn from each other. So I sure hope that it's prompting more conversations across the board.
Well, great answer, Ritu. And I feel like this is the perfect point to launch into the breakouts, because you've hit on something so important. If I can just, before we put the question up in the chat and break people out, I think it's another place that pressure could come from is the membership, right? Now, Vancity happens to be in an urban area that well known for being fairly sensitive to environmental issues. Other parts of the country, maybe not so. Saskatchewan might be an example where that's not the same culture and disposition. And so I'm really interested in the way the membership and that cooperative structure is influencing decision-making. It seems to be doing something at Vancity. Can we wait for it to happen elsewhere? Or like you say, do we need the organizations to take a leadership role? So Stan's going to post the question. It levers nicely off of this last bit of conversation. And Stan, can you put it in chat, and I'll just read it aloud, and then we're going to break out, and that includes Ritu. Some lucky group's going to have Ritu in there in the midst. So the question is, in your opinion, where can cooperatives lead in climate action? Have you seen any plans or actions from cooperatives you're familiar with that point in this direction? So Stan, break us out, please, and we'll come back in 10 minutes. So 12:50, Stan, and then we'll kind of wrap things up. So this is where we can bring it to the broader group of people here to ask questions. I know I had a great chat in my little breakout, but let's see if there's any questions that people have. I do want to respect the fact that Michelle put a question in chat here, and I'd like to read that, and then I'll open it up. Michelle, I'm just going to read your question aloud. As we can assume that any new project will abide by all environmental regulations, to what extent is the action of Vancity necessary, coming with requirements that are not legally sanctioned? Not necessarily legally sanctioned. So Ritu, can you tackle that question? So I guess why do this if you're going to be forced to do it? Which kind of gets back to the core of our conversation. Ritu, you're muted, by the way, Ritu. Sorry.
Thank you. Talking away. Yeah, it's the right thing to do, and we know if this change is coming, why not get ahead of it versus being back against the wall trying to do it in a rushed fashion. So a systematic, always taking a very mindful and inclusive approach is an important way to address any type of complex problem. So the part that's not legally sanctioned could boil down to very financial specific policies on how much you can lend over there or that. And we're not taking any active steps to really fundamentally change how we lend or where, we are taking steps on how we invest, but we've never really been in the fossil fuel industry, and whatever was left in some mutual funds and things like that, we've taken steps to exit out of that practice altogether. So, but when it comes to the lending part, we're not taking steps to say, I'm not going to lend to Ritu because she's buying, a cabin in some fire zone place, right? So we're not, that would be harmful to members to exclude them or to put barriers in place for them to get access to credit when we know that, certain changes that might happen a decade or so or 2 decades from now are, they haven't come into reality, but it's a delicate balance, so it's like really more about like the activity right now is gaining an understanding. And from there, you can take a different decision saying, okay, well, we think that regulation is coming. And if we look at those regulators, we have a line of sight, like OSFI is a federal regulator for banks in Canada, and then we have provincial ones that are different. And they give a roadmap of saying, hey, we're developing guidelines for financial institutions coming in 2023, 4 or 5. And you can get some high level line of sight into what they're expecting, but what they're expecting is financial resiliency. You're taking active steps to understand, to plan ahead, to potentially make some policy changes, but not necessarily invoking anything right now. So understanding all of these complex layers takes time.
And so, Ritu, I have 1,000 things I want to say, but one thing I might say is the regulator expects you to not wait for them to force you to do it too, right?
Yes.
if they see you waiting for them to compel you to do it, that's a black mark on your record, right? They think you're not well-run organization. So I think just on that level alone, is probably good reason to do this. And I can't help but note, Ritu, you might not you might not exclude someone from a loan who builds a cabin in the fire zone, but you could price it for risk, could you not? You could adjust the price for risk. That would be a way of kind of doing some of this. There's Jesse Kwan has a question here. Has Vancity formalized the tracking and reporting of progress via tools such as the balanced scorecard? And is executive compensation tied? Oh, that's interesting. To ESG performance at Vancity. So where is this landing at that compensation level and in reporting level?
We do have a balanced scorecard at Vancity, and we have had that for some time. It is about return on members' equity, amongst other things like membership growth and things like that. So we do have that. And executive compensation is not currently tied to ESG because that is purely part of our core principles and values. And so, as mentioned, we've taken steps to ensure that, we're not investing in things that are harmful and have exited that realm quite some time ago. So our compensation is about revenue growth, member well-being, and multiple other factors as such like that.
Well, I think that's really, really interesting question and a great response. I think if I can just add, Ritu, it'd be interesting, the question almost assumes that there's some antagonism between what the executive has, you need to incentive to do this, right? Whereas I'm hearing you say at Vancity, the fact that they're in the position means they're going to do this, right? They got hired because they've agreed that this is what the organization's about. So there's a kind of a different mentality here. At a bank, I can totally see this, right? Because their interests are profit return, and you need some incentive to move them off that target a little bit. Whereas at a credit union, it shouldn't be at odds, at least in theory, with that objective.
Yeah, you come under a lot of scrutiny if you say you're going to do something and you're not doing it, and you may have seen and heard that in some of the media. Not a good position to be in.
All right. So do we have any other questions? You can raise your hand and unmute your mic. We have time for one more, maybe 1.5 questions. Anyone want to jump in? Stan, you're watching for a hand raise here? Or?
I am.
Okay, great. Ritu, I'm gonna, I had a really great conversation with Joan had been a credit union up in northern Saskatchewan, and this is oil and gas country. And I think, the challenge that we see in particularly in Saskatchewan and Alberta is if credit unions get too far ahead on this issue, they risk alienating their members. I think so your survey findings may be reflecting, again, back to this membership and the fact that, cooperative and you have to be responsive to the membership. I'm wondering if you've seen anything. Vancity has not a province-wide footprint, but a reasonable footprint. Have you seen any differences in the reaction of members depending on where they are, relative, like, downtown Vancouver versus somewhere else?
Yeah, that's a great question. Haven't seen it per se so much, but recognize it must be out there. We talked to our colleague, credit unions across Canada, and we know province over province has a completely different profile. What's clean energy there versus a different province? You put some thoughts towards that, but we're so fundamentally different from each other in that sense, right? And there's a lot to consider. And yeah, it's kind of like that, the clash of principles, right? We know we have to make tough decisions and live by them for the benefit of this, but we're also alienating members, right? So that's where that transition risk stuff comes into play. It's like, what do those members who work in those high risk industries need? And we don't know because we're not the policy changers, but we got to keep an eye on what's coming out with that policy change and try to anticipate what does a credit union offer in that space.
Well, Ritu, I think we're at time. I want to thank you so much for a really interesting conversation. I feel like I know I could go on for a long time. This is a lot of fun and a really important conversation too. For those of you who may want to review this presentation, we'll be posting it on our website and shortly. Stan will share a link to that. And I just want to alert you to our next talk, again, the first Wednesday of every month. Our next one is about housing cooperatives, and it's going to feature Nick Falvo, Greg Sutter, to talk about a recent study they did on the cooperative housing sector and its advantages relative to the private sector. I think it's going to be a really engaging conversation. I hope you can join us. That'll be February 1st, same time, same place. Watch for the links. Thank you, everyone. Have a great rest of the day, a great new year as well. And thank you again, Ritu, for an engaging conversation.
Thank you.